Most people think that a health savings account or an HSA is simply a way to pay for medical bills. But what many people don't realize is that an HSA can actually become one of the most important retirement savings tools available. In fact, some people even call it the ultimate tax-advantaged account because of its unique triple tax advantages. In today's video, I'm going to explain what an HSA is, who qualifies, how the tax advantages work, and why this account can become incredibly valuable as you approach retirement. And if you've ever heard people talking about HSAs but never fully understood why they're such a big deal, this video is for you. So let's get started. So what is an HSA? A health savings account, or an HSA, is a special savings account designed especially for healthcare expenses. But unlike a regular savings account, HSAs can come with major tax benefits. To qualify for an HSA, you must be enrolled in a high-deductible healthcare plan, also known as an HDHP. The money you contribute to an HSA can be used for qualified medical expenses like doctor visits, prescriptions, dental expenses, vision care, deductibles, co-pays, and many other health-related expenses. One of the biggest differences between an HSA and an FSA, which is a flexible spending account, is that the HSA money rolls over year after year. There's no use it or lose it rules like there is with an FSA. That means that this account can continue to grow over time. Next, let's look at the triple tax advantages. This is the part that makes HSAs powerful. HSAs have what is called a triple tax advantage. Number one, your contributions may be tax deductible. Number two, the money inside the account can grow tax-free if it's invested. Number three, withdrawals for qualified medical expenses are tax-free. That combination is extremely rare. For example, traditional 401ks give you tax-deferred growth. Roth accounts give you tax-free withdrawals. But HSAs potentially give you both tax deductions going in and tax-free withdrawals for qualified healthcare expenses. And that is why most financial professionals consider HSAs one of the most tax-efficient accounts available. Next, let's look at who qualifies. Not everyone is eligible to contribute to an HSA. To qualify, in general, you must be enrolled in a high-deductible health plan, not be enrolled in Medicare, and not be claimed as someone else's dependent. It's also important to note that not every high-deductible plan automatically qualifies you for HSA contributions. If you're unsure, it's always a good idea to check with your employer. Next, let's look at the 2026 contribution limits. For 2026, the HSA contribution limits are $4,400 for individual coverage, $8,750 for family coverage, and if you're 55 or older, you can contribute another $1,000 in catch-up contributions. So HSAs can become a meaningful savings vehicle over time, especially if you are consistently contributing and investing the funds. Why do HSAs matter for retirement? This is where HSAs become especially interesting for people planning to retire. One of the biggest expenses many retirees face is healthcare. And healthcare costs can continue to increase as we age. So an HSA can help cover qualified medical expenses in retirement, including things like deductibles, co-pays, prescriptions, dental visits, vision care, and certain Medicare-related expenses. Many people don't realize that after age 65, you can actually withdraw money from an HSA for non-medical related expenses without penalty. Now, if it's not used for qualified medical expenses, the withdrawal becomes taxable, similar to a traditional IRA. But the penalty goes away after age 65. That flexibility is another reason that HSAs can become a valuable part of your retirement strategy. So let's look at some common HSA mistakes. Some common mistakes people make with HSAs include spending the money immediately instead of allowing it to grow over time, not investing the funds once you're eligible to invest them, assuming all health plans qualify, or forgetting about catch-up contributions after you reach age 55. Another important thing to remember is to keep good records and receipts for qualified medical expenses. HSAs are one of those accounts that many people overlook, but they can become incredibly powerful over time because of the tax advantages and the flexibility that they offer. And if you enjoy content about retirement planning, 401ks, and financial topics beyond retirement accounts, make sure to subscribe because I'll be covering more topics like this in future videos. Thanks for watching and see you in the next video.